Welcome everybody to our first conference on China Development Finance. My name is Martin Kessler and I'm the Executive Director of the Finance for Development Lab. The lab was created last year as a hub for discussion to create more space for voice from the Global South and also a mutual understanding on those important topics of development finance. And that is in this spirit that we launched last year our program on development finance, where we had a gathering of scholars and generated some research papers, and we're going to present them today. This is under the leadership of Cheng Professor Cheng of Colombia, and Ishac Diwan, who is the Director of Research of the Finance for Development Lab. I also want to thank Nick Fan and Nicole Yu from the Bill and Melinda Gates Foundation China country office for their support. The conference is a major milestone for us, and we'll have a program over 2 days. So first, this afternoon, we're going to present 2 papers, one on debt and one on SDRs after this session. And then tomorrow on topics around project success and biodiversity. But today I want to say that we're especially happy of this session to have a keynote speech by Dr. Jin Zhongxia on Chinese approach to debt restructuring and how to improve the framework. And then a conversation with Deborah Brautigam. So without further ado, I won't make one introduction. I'll leave the floor to you. Thank you very much.
Thank you. Thank you, Mr. Martin Kessler. Thank you for inviting me to attend this very interesting forum or seminar. It is my great pleasure to participate, and I would like to take this opportunity to share my observations and thoughts on the debt problem of developing countries. So let me first start with what most of us already know. China's official external lending has more than doubled in the past decade. In many debtor countries, Chinese creditors has become the single largest official bilateral creditor. And Chinese lending has helped building up more than 6,000 kilometer railway and more than 6,000 kilometers highway and hundreds of ports and power plants in Africa alone. Now, facing the debt distress of many debtor countries, Chinese creditors have also accumulating lessons on possible excessive exposure to risks that may have been overlooked. In some forum, it seems that the debt issue in developing countries is a China issue, but this is only a small part of a big picture and is therefore very misleading. The root cause for the current sovereign debt problem should be comprehensively analyzed and properly addressed. And if you look at the whole picture of the debt in developing countries, over the past decade, private sector creditors have become developing countries the largest creditors. According to the UNCTAD database, as of the end of 2020, private creditors already hold 62% of developing countries' external debt, compared with 24% held by MDBs and 14% held by bilateral official creditors. From 2009 to 2020, the share of private creditors expanded from 43% to 62%. And the share of MDBs lending shrank from 32% to 24%. And the share of bilateral official creditors shrank from 25% to 14%. And from China's own perspective, its total outstanding external lending only accounts for less than 1% of its total outstanding credit, domestic and external combined, and less than outstanding credit in an average province in China. And secondly, extremely loose financial condition after the global financial crisis has lured developing countries to overborrow and encourage risk-taking and yield-seeking by international investors. Most European bonds in developed countries have coupon rates lower than 2%, while the 10-year European bonds issued by African countries between 2013 and 2019 have coupon rates of 4% to 10%. With major economies tightening financial conditions and raising interest rate, the developing countries suffered significant exchange rate depreciation, and their debt burden aggravated severely. From May 2021 to September 2022, the dollar index appreciated by about 25%. The debt problem was further worsened by deteriorating economic conditions due to the pandemic. Since the sovereign debt problem is caused by multiple factors, it can only be tackled with comprehensive solutions, and not only comprehensive, but also a very balanced solution. Currently, the main pressure was put on official bilateral creditors, but as I mentioned earlier, they only account for 14% of developing countries' external debt. In typical countries such as Zambia, MDB and private creditor account for 14% and 42% respectively, and these two combined accounts for 56%. In Sri Lanka, MDB and private creditor account for 26 and 47% respectively, and these two combined account for 73%. So a timely solution requires a fair and equitable burden sharing by all creditors. It is also important to make a judgment on how severe the current debt problem is. MDBs have been reluctant to restructure their outstanding debt. And one argument is that we are not yet in a time of systemic debt distress, since only 10 out of 69 low-income countries have debts that are not sustainable. But if that is the case, why did we initiate systemic mechanisms such as the G20 DSSI with the participation of 73 countries, and later even launched G20 Common Framework? Some people pointed out that even if there is no systemic debt distress globally, so this should not become an excuse for a non-equitable burden sharing solution in specific cases. And people also pointed out that historically, the MDBs had experiences in participating in debt relief, including through schemes such as the heavily indebted poor countries, HIPC initiative, and the multilateral debt relief initiative, which is abbreviated as MDRI. Recently, the IMF has also taken the lead by either directly providing debt relief under the CCRT or indirectly by newly issuing SDR. Another argument is that MDBs provide highly concessional new financing, and debt restructuring will damage their credit rating and preferred creditor status. But in fact, the Chinese creditors like CDB and Exim Bank argued as a response that they also raise money by issuing bonds in the market, and that the credit rating concern should also be applicable to them. So this concern can be addressed, I think, in my opinion, can be addressed through capital increase that is provided, supported by donor countries. We fully recognize the contribution of concessional new financing of the MDBs due to its grant element. But under the current SDR of IMF World Bank, but under the current debt sustainability analysis framework of IMF and World Bank, the new credit financing, no matter how concessional it may be, will add to the existing debt stock of the debtor countries, unless it is a pure grant. With the absence of MDB's participation in debt restructuring, bilateral official creditors are effectively asked to restructure part of the debt that is not owed to them. Chinese creditors' hesitancy is further increased when they feel that privileged creditors and non-creditors are offering a big meal of debt restructuring by pushing the major creditors to pay the bill. So there are some other practical issues that are under discussion and deserve, actually it is quite time consuming actually. For example, how to treat non-resident holding of domestic currency debt. Counting it as domestic debt might be a possible approach, as such debt is denominated in local currency, or counting it as external debt and including it into total debt restructuring. Another issue, for example, is the definition of public debt. People argue, especially in China, that the definition of public debt should have a solid legal basis. Accounting SOE debt without public guarantee as public debt needs to be exercised with great caution. One more example is that for those debts that have been transformed or invested into productive assets that has already yielded a steady cash return, a differentiated approach should be encouraged. And sometimes the creditor asks the debtor countries to remove these kind of outstanding debt out of the total debt stock that need to be restructured. Chinese authorities' position on debt issue can be generally described as the following two principles based on my experience. The first is to support multilateral solutions, like the DSSI and the common framework under G20, and support the IMF's leadership in debt restructuring. And secondly, it is necessary to ensure a fair and equitable burden sharing. And China, like all others, would like to see the debt distress addressed as timely as possible. But if you really care about the welfare of the debtor countries, and really want to do it quickly, then I think you or we must do it fairly. Any obvious unfair approach will only cause delay of the whole process. So debt restructuring is a very challenging task, but if we take it positively, it may create an opportunity for debtor countries, creditor countries, and the multilateral institutions to work together and build up trust through cooperation. So I hope this session will provide an opportunity for us to exchange views and work together to facilitate a timely and orderly debt restructuring. Thank you.
Thank you very much, Dr. Jin. Deborah, you the floor. Deborah Brautigam is a professor at the Johns Hopkins University.
Thank you, Martin, and thank you, Dr. Jin, for that extremely informative approach. We really appreciate so much hearing from you. So I have a few questions, and I look forward very much to your answers. Right now, of course, some efforts at restructuring have been going on, and the Common Framework System uses the Paris Club principle of comparable treatment, which is supposed to get all the creditors except the multilaterals on board. And the IMF also has its lending into arrears policies, which is supposed to do the same thing, put pressure on all the private creditors, at least. And I wonder, what is your view of the effectiveness of these systems? Is it time to move something more like to something like a sovereign debt restructuring mechanism that the IMF tried in the past, something new that would at least include official and private creditors and perhaps at some point multilateral as well?
Yes, I think it is a big progress in my view that under the G20, the member countries reached an agreement to implement DSSI and later on to agree on a common framework to address the debt restructuring distress issue in low-income countries. But this is unprecedented, and so especially for the non-Paris Club member countries, they do not have sufficient experience, and it is sometimes difficult to change their self-perception, because not long ago the creditor club, like Paris Club, is considered as a rich countries club, and the new emerging creditors, they don't think they are rich enough to be one of the club. So this kind of cooperation is really new, and they need to learn when they start to do that. So, and also the coordination, the domestic procedure also requires some time to build up to deal with these kind of newly emerged issues. This is quite new in China because only maybe 10 years ago and at most 15 years ago, in the multilateral forum, China is always was always on the side of the borrowing countries, not on the side of the creditor countries. So this is a big transformation and shift. So the mindset and the mentality need to be adjusted and to be adaptive sufficiently. Yeah. And the mechanism you mentioned, SDRM, is a mechanism once proposed, discussed by the IMF, which is based on very rich, long time experience accumulated by creditor countries. So I think as the debt issue and the debt crisis resolution issue becomes more and more common and more frequent, it will be very helpful for some multilateral institution to continue to further their study and discussion on this kind of mechanism.
And it's very interesting. I look forward to those continued study and discussion here. So on the multilateral development bank issue, there are many ways that MDBs can participate, including by providing new finances you discussed in your talk, grants, very low interest loans. And at one point, Minister Liu Kun, China's Minister of Finance, proposed, he praised the IMF's Catastrophe Containment and Relief Trust, the CCRT that you also mentioned. And the IMF was using this to help 4 countries pay IMF debt service. And he said, if the World Bank takes part in debt treatment through setting up a multilateral debt relief facility, China will positively consider contributing. I wonder, is this option still on the table? Would China support a trust fund like this at the World Bank as a way of MDBs participating in debt treatment?
I think actually I haven't read this news or statement by Mr. Liu Kun, but I feel that this is consistent with the official position of the Chinese authority, as I know, and I believe that if the MDBs like World Bank can start to can make its efforts to mobilize the resources that is needed for debt restructuring, for its participation in the debt restructuring, China will be sure to participate.
Let me ask you about some of the Chinese development finance institutions. For China and a number of other countries in the world, development finance is a kind of a hybrid. And Chinese resistance to classifying its commercially run state-owned lending as either official or private seems reasonable, because there really isn't any private lending going on at that level in China. And during the DSSI, China was pushed to distinguish where its state-owned policy banks fell on that official and non-official spectrum. And this was actually a very important step. For example, at the IMF, when creditors are part of a debt discussion, they have to be either official or non-official lenders. And so in a fireside chat, at one point, you had said earlier that we have persuaded China Development Bank to participate voluntarily in the DSSI. And in a study that we've conducted, we saw quite some substantial suspensions by China Development Bank during that DSSI period. And then you mentioned that even for China Exim Bank, there was internal debate in China about whether we should categorize them as a pure official creditor. And I wonder if you could tell us more about these debates and what are the chances for reform that would make these distinctions clearly, for example, like what Germany has done with KfW and KfW IPEX. And then in the common framework, is CDB going to participate as an official or as a private creditor?
Oh, yeah.
That's a lot of questions.
Yeah, I think I know that this issue, how we define CDB's lending and Exim Bank's lending as official or non-official is really very confusing in international forums. And I think this is related with the character of China as a transition economy, actually. We all know that in the past several decades, China is has been transitioning from a planned economy into a market economy. And also for the state-owned banks, actually we reformed them, we reformed these state-owned banks into a market-oriented commercially operated banks. And for those big 4 or big 5 in China and many other shareholding banks, they have already become public listed companies. And so they are very commercially oriented. And for the China Development Bank and Exim Bank, actually these two banks has also undergone some commercialization process. And for the Exim Bank of China, even if we already classified all the credit of Exim Bank of China into official bilateral creditors, actually only about 2/3 of its credit is subsidized and can be considered as a really official bilateral credit. And the remaining 1/3 actually is also commercially oriented, and the decision making is purely based on market considerations without any subsidy or any instruction from higher authority. But for a simplified approach, at the beginning of the G20 DSSI discussion, I think the authority put the entire lending of the Exim Bank into the category of bilateral official lending. And for the lending made by China Development Bank, it's really there is no any subsidy at all from the central government. They conduct their fact-finding, project selection, appraisal, and decision making purely based on their own commercial judgment. And both China Development Bank and Exim Bank of China, they raise capital from the market by issuing the bonds, and also they have to be audited every year, and they submit their profits to the government because the government is the largest shareholder of these banks. So these kind of SOE reform is very common in the past several decades. So unless there is a very explicit central bank guarantee, so their activity, their projects lending has to be considered as commercial. So although these banks are still state-owned, so we cannot say that these banks are private banks, but their lending are purely, especially the CDB's lending, are purely commercially based. So this is the background of I think these two banks' position and the Chinese authorities' position in classifying these two banks.
Thanks so much for that. I think we're just about at the end of our time together. Martin, do we have any wiggle room on this?
If Dr. Jin agrees to have one last question, I'm happy to leave a little bit of time on the next session. Yeah.
Can we get one more question in, Dr. Jin?
Okay.
Okay, so this is a big one. It's about the debates that I imagine are going on inside China about debt restructuring. And you alluded a little bit to these in your remarks. And on the one hand, you have a group, I'm sure, that are saying that there's not yet a systemic crisis, and that countries like Zambia and Sri Lanka can recover. Copper prices can go up, tourism can come back. Maybe it's a short term and a moratorium will work. And they resist the idea that China must take on this loss. And maybe even they point to geopolitics, saying that, this is a geopolitical issue, not an economic issue. On the other hand, there's a group looking at China's long-term interests and long-term debt collectability and saying, if we move quickly, then we have a better chance of collecting the rest of these debts. And that going in quickly with the IMF is something that could also reflect China's position as a responsible stakeholder, responsible power. And I wonder which side is winning.
Oh, yeah. Yeah, there are maybe some different opinions. So this is very common in a country, especially in a country that without much experience in offshore debt restructuring. But actually, the one argument I mentioned in my speech that the current debt distress in developed country is not a systemic crisis. Actually, it's not a view in any camps in China, within China. Actually, it's a view of the IMF and World Bank. So, because the World Bank and IMF, the staff, they have drafted a staff report and discussed in the board. And the major conclusion of the staff report is that so the current debt distress is less severe than the debt crisis in the late 1980s. And that triggered the HIPIC initiative. So this is the conclusion of the IMF and World Bank staff report. So this actually also puzzled me, because if this is the case, why just 1 or 2 years ago, under the G20 framework, the major countries formed a consensus that we need to make up a DSSI and also later on to formulate a common framework. So it seems that we are dealing with a non-systematic crisis or distress with a systematic approach. So this is something puzzled me. And of course, as you mentioned, that there must be different opinions inside any country, including China. But I could say that both camps have their points, actually. And the authorities' position as a result of a comprehensive summing up of all the positions or all the points, views expressed in China, the official position is that we need to, in most cases, we should follow a multilateral approach. We need to adhere to multilateralism, and we support mutually beneficial and win-win solution. And we also appreciate and support the leadership role of the IMF in coordinating the debt restructuring issue, and we are willing to cooperate with other countries to address the debt distress issue in developing countries. But on the other hand, we all expressed our view that the IMF should increase its transparency in formulating and distributing, proposing its debt sustainability analysis, and also solicit feedbacks and opinions from all the stakeholders, including the debtor and the creditor countries. And so these higher transparency and more discussion before finalizing the conclusion of this report will be very helpful to help different camps in a member country, including debtor countries, to form a consensus. Because all these different opinions, in many cases, arise from imperfect information or asymmetric information. And yeah, so I think a real multilateral solution should be inclusive, to include all the stakeholders, to participate in a equitable burden sharing approach. Otherwise, it is very controversial, including in China, that some people will challenge that this is really not a real multilateral approach, because some member in the multilateral framework actually do not participate. So this will greatly increase the difficulty and in reaching consensus in creature countries like China.
Thank you so much. Martin, back to you.
Thank you very much. This answer session. Thank you, Dr. Jin. Thank you, Deborah. So we're switching session. I invite Cheng, Jin, and Gong to turn on the camera, and I give the ability for Gong to share your screen.
Martin, I cannot turn on the video. Some hosts need to give me the right.
Okay, I will do that. Gong, you can go ahead and change in. Let me do that.
Great. All right. Good morning, good afternoon, good evening, everyone. Let me also start by thanking Dr. Jin Zhongxia for his remarks, and Professor Deborah Brautigam for her questions and remarks. They help us to understand better with the Chinese approach to debt restructuring. Our next session features two analytical pieces, and we have two present papers and then 3 discussants. So let me just remind our speakers. So let me suggest that each presenter, Dr. Cheng and also Ms. Ryder later, maybe each use 15 minutes initially for our presentation, and a discussant 5 minutes each. And we have time, we can invite questions from other participants. Other participants, feel free to leave questions in the Q&A session. Q&A part of the Zoom. So Dr. Cheng, as we heard from Dr. Jin Zhongxia, equitable treatment is a phrase that he mentioned multiple times in his remarks, and you're going to tell us about whether achieving comparable treatment was the effort. Dr. Cheng, please go ahead.
Thank you very much, Shang-Jin, for your introduction, and thank you. Many thanks to FDL actually to invite Aitor, Erce, my co-author. He is also here, and myself to present our new work on this creditors coordination. And precisely as Shang-Jin mentioned, I also noticed the 2 keywords from Dr. Jin Zhongxia's speech. So burden sharing and also multilateralism. And here we're going to talk from a data point, actually to read historical data about how different creditors interacted in debt relief games. And here, unfortunately, we don't touch upon multilateral institutions. We mainly focus on 3 types of creditors that I'm going to present in the following slides. Before I continue, I just want to say that the views presented here are those of the authors and do not necessarily present the views of the BAS. And we thank FDL with the great research assistance provided from actually Deborah, Guillaume, and also Deborah. So in this work, we talk about coordination and burden sharing among different types of creditors. And we know that in the Paris Club, one of the founding principles is about comparability of treatment. However, as literature has told us, inter-creditor coordination has become increasingly difficult over time. So coordination, we talk first about the Paris Club with private sector creditors. So in the 80s, this is why actually we saw some successful COT or comparability of treatment application. Why? Because back then, so the debt restructuring involved a lot of syndicated loans from big international banks. And those banks actually have very strong relations with their governments, which are also the major shareholder, or say back then a handful of advanced economies that sit in the Paris Club. So these informal public sector pressures, mainly through regulatory agencies, were crucial for us to actually see those successful COT application. However, from mid-90s, cooperation here between the Paris Club and the private creditors has already become a bit more complex due to diversification of creditor types. And here we mainly talk about bondholders that have become more and more important in debt restructuring events. And from 2000 onwards, there's also a big elephant in the room that Dr. Jin also talked about. So the emergence of China alongside other non-Paris Club bilateral official creditors. So they have been playing a very important role in official lending and thus in debt restructurings. And here, what we want to do is to provide a way to look into historical restructuring data, and from there actually to build indicators about the ways different creditors have interacted among themselves. Here we'll call this type of interaction a de facto inter-creditor coordination, in the sense that we remain agnostic about COT application, although we can tell things about the COT application from our dataset, but we rather build indicators or coincidence indices to see how different creditors have provided debt relief in a given country in a very closely defined time window. And for instance, we interpret the time series of debt relief as the outcome of creditors playing a repeated debt relief game. Each time there probably is one type of creditor providing debt relief, and then followed or not by other types of creditors. And we basically look into 3 dimensions. And first of all is this time dimension. So we want to know, does the data support de facto coordination? So by definition, if there are successful leadership or failed leadership for one type of creditor to be the first mover in providing debt restructuring, followed or not by other types of creditors. And secondly, so we look at the size and terms. So do creditors coordinate on the size of debt treated, and whether this de facto coordination would affect the debt restructuring terms. And finally, we also want to use an empirical exercise to show whether de facto coordination could affect post-restructuring macro outcomes in debtor countries. So our data collection and also data transformation, this is a major part of our current work. So we put together 3 databases of debt restructurings. So Paris Club, from my previous work with Aitor and co-authors, which cover actually the period from 56 with the first events with Argentina to 2019. And then the second type of creditor is private sector creditors. So for this, we built upon Assunuma Kebret's work, but we also updated their database to the latest period, so until 2019. And then the third one is China, which is the biggest non-Paris Club bilateral official creditor. So based upon my own work on China debt restructurings, together with also Deborah's work and also aid data 2021, all updated to 2019. We purposely carved out the DSSI and common framework periods out, because this is sort of formal coordination arrangements, at least between the Paris Club and China. And we also collect macro data from standard data source. So the first work actually is about the bundling restructuring events into restructuring episodes. So this is quite important, as supported by other authors in the literature, to say that we should consider effective restructuring periods instead of to take many events that fall in a very close time window as separate events, especially for our work on creditor coordination. This is very important. Otherwise, we would have overestimated the effect. I'm going to showcase this transformation together about later on. We talk about games, restructuring games, with the diagram as you can see here. So first of all, we have three different type of creditors. Say Paris Club. You can see in one country, the Paris Club has provided 3 restructurings. Just as the example, in January 88, July 88, and February 92. And then you can see that there are 2 events that fall in the very close time window. Those are the 2 first events, right? Within 18 months, this is the mechanical rule actually we set. We can change. We also did quite a few other specifications. And here we present this baseline scenario with, so we say we would aggregate 2 events into 1 effective episode if these 2 events provided by the same type of creditor within 18 months. So with this definition, we would bundle these 2 events together as 1 effective episode. Behind actually, we also aggregate data like debt treated, also MPV haircuts, nominal value reduction, using, for instance, the debt treated as weights. So this is about 1 type of creditor. We do the same thing actually for private sector and for China. And then the second step is to define a coincidence index, or who is the leader in the game and who is the follower in the game, and how to look at events, episodes provided by different creditors in this debt relief games. So one typical example is you can look at the private sector, this yellow line, November 88. So November 88 is very close actually to a Paris Club event defined with this rectangular. Within 24, actually after the July 88 restructuring provided by the Paris Club, we see that the private sector provided a debt restructuring in November 88, which is within a 2-year window or 24 months. And we use this definition actually to define a leader to define first a debt relief game. So we would bundle these 2 episodes together. In that case, the Paris Club would be the leader or the first mover in this debt relief game, followed by a private sector restructuring. The same thing you can observe here between China and private sector as an illustration. So using the same definition of 24 months as a time window to define this debt relief game, we can also see that the China May 2001 as a first mover, followed by a private sector debt relief action. By doing so, actually, we shrink the size of the, so we aggregate the defaults or restructuring events to episodes. As you can see from this table, in total, we have 338 episodes from the Paris Club, 150 from the private sector, and 163 from China, about a 20% shrink from the initial event-based approach. This is quite important in order to not to look at actually those events falling in the very close window as separate events. And then from this episodes, as defined in the table, we look at the dynamics between different creditors, and then this forms 521 games involving different type of creditors. So I want to show upfront actually results to the audience about the Paris Club. So we have also done a similar exercise for China and the private sector. So here on the left-hand side, you can see the breakdown of Paris Club episodes by decades. And you can see that at the beginning, of course, the Paris Club was the sole framework to deal with sovereign debt issues. So in the 90s and also in the 70s, basically, the Paris Club was the first mover or the only mover. In the 70s, the Paris Club started to be followed by the private creditors represented by this darker brown color. And throughout the time, you can see Paris Club has been very frequently the first mover. And then if you want to look at the breakdown of who are the followers, so let's look at the right-hand side panel. In the 70s, 80s, and 90s, basically the private sector, represented again by this brown color, is the sole follower to the Paris Club. Whenever there's a game, there is the Paris Club serving as the first mover. It is always followed by the private sector creditors. However, things has dramatically changed since 2000, when China emerged as a biggest lender, sovereign lender. And you can see that although China has restructured a lot of debt alone out of its own initiative, but these charts still show that China has participated or has provided debt relief in a very close time window within 2 years following a Paris Club event. And especially—
Dr. Cheng, sorry for apologies. 2-minute reminder. 2 minutes, please.
Sure. Okay, so this is basically the most important fact we want to show to the audience about how we construct the data. So I already conveyed the most important message. And then, of course, we can look at how this kind of coordination would affect the size of debt treated. So the Paris Club treated more debts in the 80s to 90s. The private sector actually so also tend to provide more debt treatment following the Paris Club as the first mover. And China provided higher debt treatment when acting alone in 2000 to 2019. Also, a very important fact I want to highlight is this kind of games could also affect the restructuring terms. The upper table shows you a lot of negative correlations between the size of debt treated provided by the first mover versus followers. So there's sort of competition among different creditors in providing debt relief. The more debts treated by the first mover, the less the followers would provide debt treatment. However, in terms of terms, we see some emulation among creditors providing nominal value reduction, because you see there are quite a few positive numbers there. So for instance, for China, China's effort is subsequently matched by higher nominal value reduction from the Paris Club, especially in the 2000 to 2019 period. And we also started to, to end on this presentation, so we look at actually the macro implications with especially one empirical strategy to look at how growth and debt would change for the group of games which are coordinated versus uncoordinated. And here, just very quickly to show you results based on a continuous variable as the independent variable, which is the debt treated for a coordinated cases versus non-coordinated cases. You can see that actually debt is significantly lowered after the treatment within the after 4 years after the restructuring, associated in clearly in those cases when we see coordination between the 3 types of creditors. So this is quite a strong result, and probably the growth effect comes from the fact that debt is lowered, so additional resources could be used for more productive investments. Let me conclude here. So data show defector creditor coordination, which affects the size and terms of restructurings. So the Paris Club often acted as a lead in the debt restructuring game. The private sector often interacted with bilateral creditors, and it treats more debts when it is followed when it is following actually the Paris Club. China also provided restructuring in many cases alone, but it also followed the Paris Club more often than the private sector. And especially we see some emulation between the Paris Club and China. They tend to provide more principal value reduction, so nominal haircuts, when the other party does so. And finally, preliminary results show that the debt dynamics improve in cases with de facto coordination. So this provides some insight into this current debate, as Dr. Jin has mentioned about the common framework at ESSI. So actually we need more creditors on the table actually to provide debt relief, and especially to see this sustained reduction in sovereign debt after the restructuring. So I stop here. There are some other ideas we can discuss about the future research. We can do that during the Q&A session.
Thank you very much, Dr. Cheng. Before I turn to our discussant, let me note several people on the Zoom panel are requesting presentation files from all speakers and discussants. If you don't mind posting your slides in the chat room, that will be a great help to our participants. So now let me turn to Diego Rivetti from the World Bank to discuss Dr. Chen's presentation. Diego, please.
Thank you very much, Mr. Chair. I would like to share my screen, if it's possible. I'll prepare a couple of slides.
So someone, Martin, someone needs to,
Yeah, now you should be able to.
Yeah, perhaps you can give rights to all other panelists.
Yeah, it should be on screen now. Can you see the slide?
Yes.
Wonderful. So first of all, thank you very much for the invitation, and congratulations to Gong and Aitor on this very timely and useful paper that really contributes to the ongoing debate on the intercreditor coordination. So I was thinking about how to prepare this discussion, and I decided to focus on two main topics. First of all, a description of the existing intercreditor coordination mechanism and its limitation, and finally a few suggestions for the paper. So let me start as a background introduction with a brief description of the current approach. The traditional approach is a two-step and sequential approach. First, Paris Club bilateral creditors reach an agreement, and of course, in the case of common framework, we talk about the creditor committee. And second, the borrowers are asked to seek comparable treatment from other creditors, namely non-Paris Club, if it's a Paris Club restructuring, or private creditors, if it's a common framework one. So this is the traditional approach. Again, two-step and sequential. Comparability of treatment is assessed ex post based on the analysis of one or more of the criteria that you see in the slide. The change in nominal debt service over the consolidation period. The consolidation period is equivalent to the IMF program. The extension of the duration of the treated claim, or the NPV reduction, particularly in case of stock treatment. So one or more of these criteria can be used to assess, again, ex post the comparability of treatment. And this methodology is applied, for instance, to private claims as a class, as a category. So that's the current approach. What is, let's say, problematic with this approach? I think there are two issues. One is that it may trigger a non-cooperative game between official and private creditors. Why? Because in the end, the official may not want to provide deep debt relief without knowing how the creditors, the private creditors, would move. And that's pretty much what the paper from Aitor and Gong explains. And that, of course, increases the likelihood of light restructuring, at least in the first phase. And the second consequence is that this approach may extend the length of the negotiation phase, again, because you have a two-step negotiation. That's the first point. The second point is that some borrowers may even decide to negotiate first with the private creditors, and that happened in the past. And again, there are a number of episodes mentioned in the paper of borrowers that decide to strike a deal first with bondholders and then go to the Paris Club. Ukraine, Moldova, many cases. I think one of the most interesting one was Ecuador in 2008, that defaulted and decided to restructure first is private debt with the bondholders, and then went to the Paris Club, and the Paris Club didn't match the relatively generous debt relief provided by the bondholders. That's just to say that there is no evidence, at least, of reverse comparability. No? So if the borrowers go first with the private, it is not given that the Paris Club would match the terms provided by the private creditors. So these are the two main issues, I would say. So the bottom line is that we have to consider whether moral suasion alone can ensure comparability of treatment, particularly with private investors. So as the paper rightly said, Paris Club typically takes the lead for a simple reason, because country would restructure their debt typically in an IMF program. There are very few cases of countries that decide to restructure outside an IMF program, and for the IMF program to be approved, the IMF need financial assurances, no? And financial assurances are provided by the bilateral creditors, and so the Paris Club or the Common Framework Creditor Committee. So that's why the Paris Club takes the lead. Now, the thing is that in the past, the system worked well because the private lenders would follow suit, and because they were represented by international banks with relatively strong ties with the Paris Club governments. Now, as we all know, the private sector is much more diverse, and bondholders in the end follow just a separate negotiation track, which is driven by other factors. They may have different assumptions on the macro fiscal perspective of the country. If you take the case of Suriname, they may have different assumptions on the future pricing of the debt instruments. Also, the investor base is composition may be more or less conducive to a swift negotiation. And finally, there's the issue of the capacity of some creditors to enforce the payments. And so right now, the real only enforcement channel that we have is the IMF lending into arrears. Here you have two questions. First is, does the IMF have unlimited firepower? And is it willing to use it? Meaning, can the IMF afford to lend into arrears if the private sector doesn't play game for years? And doesn't accept the terms that are needed to restore that sustainability. And the second question is this approach effective when debt is collateralized? And we had already in the recent past a number of cases, take Chad or Congo Republic, of private claims that are super senior, they are collateralized. So this is to me the key question. And going back to the paper, I think there are three main avenues to explore, and I would start from exploring whether comparability of treatment was actually achieved and enforced in the past. And here you have a list, a non-exhaustive list of cases where comparability of treatment was either not requested or not achieved. So, for instance, in the case of the HIPIC, between the decision and the completion point, some countries issued bond, but the participation of those bonds to the debt relief was not required. There is the de minimis rule, So if the portfolio is relatively small, the portfolio of bonds or commercial debt is relatively small, it can be excluded. But in some cases, this portfolio was even higher than 10% of the total debt portfolio. So relatively important. Yet, the participation of the private sector was not required. There is the case of the DSSI that we all know. In some cases, the calculation is not easy because the data is not easy to compare. In some cases, just the comparability of treatment was not granted or not achieved. So I think it would be interesting to explore these cases and see when and why comparability of treatment was achieved or not in the past. So,
Dr. Rivetti, apologies. Yes. 1 minute, please.
Yes,
1 minute.
Very quickly, 2 more slides. A second suggestion is considering also the impact of past debt restructuring. So the note analyze the amount of debt treated, but on top of the amount, it's also important to assess the NPV reduction provided by the different categories of creditors. And here it's very important to stress that the Paris Club typically reschedule the debt service falling due in the consolidation period, and in case of reprofiling, while the Chinese and the private creditors typically amend the entire stock of the loan of the bonds. So they provide an extension of the maturity or amend the interest rate. So this is a difference that has to be taken into consideration when calculating the NPV reduction. And the very last suggestion is to also look at the comparability of treatment among bilateral creditors. So we typically look at the comparability of treatment between category of creditors, private, Paris Club, non-Paris Club, and commercial. It's also interesting to look at the difference within category. And here you have a graph that is taken from a forthcoming paper drafted with David Millahi. You see that the dispersion in interest rate among the bilateral creditors. Here, the distribution of the interest rate on the outstanding public debt in low-income countries. So you see, you have major multilaterals that provide highly concessional loans and account for almost 50% of the total outstanding. But then you see a lot of red, a lot of purple, meaning that like bilaterals may offer loans that are not concessional, and in some cases the interest rate is even higher than 5%. No, over 20% of the existing outstanding debt with bilateral has an interest rate which is higher than 5%, which is for the DSA the threshold, no, to ensure NPV neutrality. So the question here would be, if we assume as in the case of the DSSI, an NPV neutral approach in the reprofiling, is this a way of achieving comparability of treatment? Is it a way of achieving equal burden sharing? And I leave this question to the audience. Thank you very much for listening, and happy to take any question you may have.
Thank you very much. I'm sure there will be a lot of questions, but we're going to consolidate our Q&A after the second paper. But I would suggest that if you have questions, you can ask in Q&A, and Gong Cheng and his co-author feel free to respond to the questions in the Q&A session. So let me now turn to our second presentation by Hanan Ryder, who is the CEO and founder of Development Reimagined, and she will share her thoughts with her co-authors on what should China do with its SDR. Please.
Thank you, Shangjingwei. 大家上午好，晚上好. Hello, everyone. Let me just share the screen for this presentation. It's a pleasure to be with you today. I'm going to be presenting this. I'm going to be co-presenting with my colleague, Etsehiwot Kebret, who's also here. Let me just actually start the presentation first, would be a good idea. And our topic for the presentation is China's special drawing rights to African countries and options for channeling the special drawing rights to the African continent. This is obviously a very important discussion, and our aim in particular to present is really to look at this issue from both an African and a Chinese perspective and see what really makes sense from both of those perspectives, not necessarily taking into account really prioritizing those perspectives. So for those of you that are not aware, but I'm sure those of you on this discussion are aware, special drawing rights are, where is? I should have a second slide here that hasn't come up. Special drawing rights were created in 1969 by the INARBE and its members. Special drawing rights are both an asset and a liability. They don't create a debt for a recipient, but they also come in with no conditionality and a fairly low interest rate that tends to be quite attractive. And that, of course, we will come back to that point. There have been a few one-off allocations of special drawing rights in the past since their creation, but the largest allocation was in 2021 with the allocation, one-off $650 billion equivalent of special drawing rights as a means of responding to the COVID-19 crisis globally. Countries hold special drawing rights, as do 20 prescribed holders who are other types of banks and organizations, and 5 of those have become prescribed holders in recent years. With the latest allocation, the $650 billion allocation, the decision was taken to allocate these according to the quota size of countries in the IMF, meaning that the US, for instance, received $113 billion equivalent, or 17% of the total, and China received 40 billion, and African countries in total 33 billion. I will come back to those points. Thereafter, in November 2021, during the 8th Forum on China-Africa Cooperation, which took place in Dakar, in Senegal, China made a commitment to reallocate $10 billion equivalent of the 40 billion special drawing rights that it had received to African countries, and specifically to African countries, and that accounted for around 25% of its new SDR allocation, which at the time was the largest proportion of SDR allocations committed to reallocate by any country in the IMF. So it's important, before we continue to what the options are, and my colleague Etze will explain those options, just to give you an idea of what the kind of priorities and views are with regards to special drawing rights from the African side and also the Chinese side. First of all, it is very clear that the special drawing rights are poorly allocated as they were. Very little, as I said, went to the African continent, 5% of the total, which means very little in global terms. For African countries, for instance, if you compare the 33 billion to what African countries spent on COVID-19 just in 2020 and 2021, which my firm calculated, African governments spent over $130 billion over those 2 years. So 33 really doesn't really compensate much at all. And of the allocation, once you actually distribute that across the African continent, again, because of this very odd quota mechanism, the average amount that went to the African economy, to each African country, was around 623 million, and the median was 275 million. South Africa got the most, and this is in an infographic that we released last week, but just, you know, it explains the overall inequality globally, but also within the continent. And what can 275 million do as a liquidity measure? Nevertheless, it is helpful as a liquidity measure for some countries, and especially in the absence of an African monetary fund. The African region is the only region that does not have its own monetary fund, and so these kinds of measures can be very helpful. And it does mean, for instance, and does explain why 90% of the special drawing rights on the African continent have already been used. The African region has the highest take-up in the world of special drawing rights. So this is an important background. The last point with regards to African priorities on special drawing rights is that they can be a valuable means to gain concessional and high return finance, and use high return finance, which is much needed. And at Development Reimagined, we are very clear that what we are in is a crisis of too little debt, not too much debt, nor do we believe that debts have been used badly throughout. However, the multilateral system is not strong enough to provide finance. And again, this is an opportunity to use SDRs in a way that addresses those long-term problems, strategic considerations. For China, similarly, China has key views on special drawing rights. In particular, informed by the addition of the RMB to the basket of currencies that define the value of special drawing rights, and that was perceived as a milestone of RMB internationalization, or de-dollarization, whatever you'd like to call it, in October 2016. And a number of different organizations deal with special drawing rights and their policies, but really it is obviously PBOC that really takes the lead. But in terms of the execution of SDR policies and the use, there are a number of different institutions that work on that and use that. In addition, it's important to understand the commitment on SDRs in the context of China's, the commitment on use of SDRs for the African continent in the context of China's work with the African continent, This was the only SDR allocation that China has committed, publicly at least. And if one understands that point, this was also an opportunity to provide finance that is unconditional and concessional for African countries, which is highly needed in the context of the COVID-19 recovery, as well as in the context of a too little debt crisis. So I'm going to hand over to my colleague now to explain the 5 options and where we came out on what those 5 options might be, how they rank. Over to you, Etze.
Hannah. So this options paper looks at 5 options. Can you hear me?
Yeah, we can hear you.
Okay. Yes. Sorry, shaky internet. So this options paper looks at 5 options on how China can reallocate their SDRs to the African continent. So the paper looks into the opportunities and challenges of each option and critically assesses each option based on bespoke criteria, which I'll speak about in a bit, that reflects both the interests and priorities of both Chinese and African stakeholders. So we explore reallocation through 5 options, through bilateral transfers, through the African development, specifically the bank's hybrid capital instrument, the Africa Growing Together Fund and climate action window, reallocation through the World Bank, and also reallocation through IMF instruments, specifically the PRGT and RST, as well as exploring reallocation through non-prescribed holders, namely the LSF, which is the Liquidity and Sustainability Facility. So then to speak a bit about the assessment criteria. So in order to assess the 5 options I just mentioned, we developed 5 criteria based off of our research and analysis, as well as understanding of the priorities of both African countries and the Chinese government. So the first thing that we look at is the numbers and types of countries that are benefiting. So this criteria looks at how many countries stand to benefit from reallocation. So given how Chinese development banks have operated to date, the assumption behind this criteria is that China will prefer more countries to benefit than less. The criteria also looks at whether African countries at different income levels will benefit and assume that the more diversity of income levels, the better. We also look at distribution of financing towards growth-inducing projects. So this criteria assesses each option depending on which sectors will benefit from the additional financing. And if so, whether this aligns with both African and Chinese aspirations, specifically those that are set out at FOCAC 2021, specifically, for instance, infrastructure, which is a core area of focus for both. We also look at the SDR reallocation process. So before committing to reallocating SDRs, through a specific instrument, Chinese stakeholders as well as African countries will want to know the details of that reallocation process. So a process that is very clear will obviously be ranked higher. We also look at results monitoring. So once SDRs have been reallocated and countries have begun to benefit from this allocation, it's really important to understand how both African and Chinese government, businesses, and citizens can actually see how that funding has supported individual projects. And lastly, we look at maintaining sovereignty. So this looks at the level of ownership that African countries have when receiving finance. So this criteria essentially assesses the degree to which African countries have the flexibility to direct that financing to areas that are most needed. Criteria is given between 1 to 10 points, so with an option having a maximum of 10 points. So the first option we look at is bilateral transfers. So as we all know, under IMF's articles of agreement, bilateral lending and donations of SDRs are allowed. However, there is very limited indication about whether many high-income countries are considering this option. And this is due to a host of different reasons, including domestic and legal obstacles. So as African central banks are the main holders of SDRs, SDRs directly reallocated through bilateral transfers can play a role similar to currency swaps between central banks and can provide RMB liquidity. So over the past few years, to advance the RMB internationalization strategy, People's Bank of China has arranged bilateral currency swaps with central banks around the world. And as the evidence suggests, currency swaps can be extremely beneficial when it comes to bilateral trade and integration into global value networks through exports to China. And we've also seen in our research that central banks of 3 African countries, namely Nigeria, Egypt, and South Africa, have entered into swap agreements with the People's Bank of China. And we also know that Saudi Arabia, for instance, has conducted bilateral transfers to Pakistan and Egypt in 2021. And then moving on to our second option, which is reallocation through the African Development Bank. So the first option that we look at is the hybrid capital instrument. So the AFDB has created a proposal for the IMF that would allow member countries to reallocate their SDRs through this instrument. Eligible members include middle-income countries, as well as private sector, and a few select low-income countries. And through this instrument, if a country like China were to reallocate their SDRs, the bank will leverage that contribution 3 to 4 times. And the second instrument that we look at is the Africa Growing Together Fund, which is a 10-year co-financing fund between AFDB and the People's Bank of China between 2014 and 2024 that supports African countries in their priorities to advance economic growth and social cooperation on the continent. And then we also look at the Climate Action Window, which is a funding instrument proposed as part of the ADF Africa Development Fund replenishment process, and is dedicating its financing towards climate projects and activities across the continent, and supports about 37 countries that the ADF currently operates in.
Apologies.
Next,
2 minutes reminder. 2 minutes. Thank you.
yes, okay. And the third option that we look at is reallocation through IMF instruments. So the PRGT, which is the first instrument we look at, provides concessional financing to low-income countries and is considered in many ways to be the easiest option for reallocation of SDRs. And the RST, which was established in 2022 in April, supports countries' long-term balance of payments and builds resilience to external shocks. And there are currently 143 eligible members of the RST. And we know today that countries such as China, Germany, Japan, and Spain have already signed contribution agreements with the IMF on the RST. And the fourth option we look at is reallocating through the World Bank. As we know, both IDA, the International Development Association, and the International Bank for Reconstruction and Development are prescribed holders of SDRs. Unfortunately, as of today, the World Bank has not channeled SDRs through these instruments, and it doesn't seem that they'll be doing so anytime soon. However, there have been discussions around new ways of using SDRs by multilateral development banks, specifically through SDR-denominated banks, and this has been advocated by Stefan Parduano, who's been pushing for this, for the World Bank specifically to issue SDR-denominated banks, and this is not something that is new, as the World Bank has already done this back in 2016. And lastly, the fifth option really explores reallocation through non-prescribed holders. So over the last few years, particularly through after the last general allocation, there's been a push for the IMF to expand the list of prescribed holders to increase the financing and resources that are available to low-income countries. So in this paper, we explore reallocation through the LSF, which is a Eurobond repurchasing facility that provides liquidity to African sovereign borrowers, and these borrowers' attractiveness to international bond markets. Now, although the LSF is not a prescribed holder, there are opportunities for SDR on lending to occur, where on-lend SDRs will serve as funding to the LSF to pay private sector investors the cash value of their African sovereign bonds. And so for China specifically, there are 2 options via the LSF. The first is to push for the IMF to open a line of credit to the LSF, or for China to open a line of credit directly to the LSF. And this paper explores these processes in greater depth. And so on to our last slide. So at the end of our paper, we score each of the 5 options that I've mentioned. And this is a summary table of that scoring. So if we look at the IMF and World Bank, for instance, they score very low on the criteria of maintaining sovereignty. And this is due to the conditionalities that come with these instruments. You can see that it's a sharp contrast with AFDB and the LSF, not to mention that it's not possible to earmark contributions to the IMF and World Bank instruments for African countries. These institutions have also scored low on distribution of financing. The RST, for instance, is focused only on long-term structural challenges such as climate change and pandemic awareness. And we've also given low scores to the World Bank and bilateral transfer options on the SDR reallocation process, as these processes are still not clear or fully developed. And lastly, as clearly seen, AFDB and LSF score the highest points from all of these options. And what distinguishes these high scores is one, these options put African priorities and ownership and agency first. These instruments have a very clear SDR reallocation process, and these instruments support many African countries. And in many ways, this scoring has shown that it is possible to bridge both African and Chinese SDR priorities, and we hope that these assessment criteria will be considered.
Thank you very much. Great, thank you very much. So we have two discussants. Let me first invite Ryder Moore from Center for Global Development, please.
Thank you. Such a pleasure to be here this morning. Thanks for the presentations and especially this one. So I just wanted to make a number of points that for a long time now, other actors in the international financial system have argued that the system as structured is no longer fit for purpose. China has made this argument. Many African countries have made this argument, and the paper on the SDR shows that the way it's structured, that in times of crisis, the countries least in need of the SDR get most of the SDR. So how do we reform that process so that the countries in need of the SDR get it? The second thing is that the system has become significantly more complex. We now have GSIBs, globally systematic important banks. These are banks that are too big to fail and that themselves are sources of risk to the international system. Even though we've established those banks, now we're realizing that some regional banks might be systematically important too. Silicon Valley Bank was not a GSIB, but the failure of Silicon Valley Bank is what got us in the problem we're facing now. So if we're going to build an international financial architecture, we have to understand the nodes of risk. The difficulty, I think, has been that the institutions themselves, World Bank, IMF, seem resistant to innovative ways to change. We're struggling to get them to that point. So as you saw in the paper, in the presentation, there are other options on the table. The African Development Bank went out of its way to address all of the concerns. There was the concern about if onward lending to the African Development Bank will allow the SDR to retain their reserve status. The African Development Bank answered that question. As the paper noted, Stephen Paduano and Brad Stetzer have this idea of SDR denominated bond, all of these. So what Development Reimagined has done here is simply put another option on the table of how the international financial system can be rejigged so that it actually benefits the country that are most in need of it. So I think this is an excellent recommendation. It's one of the many recommendations that are coming from outside the international financial system. It's not coming from within the bank. It's not coming from the IMF. It's coming from outside of those institutions. The final thing that I would say here is that in a time of great power conflict, I think there have been talk of how can African countries use this system, use these changes in the system to their benefit. I think here is an excellent opportunity. Because if the African countries can work out a possibility, work out a process whereby China's SDRs get lent to African countries, you can take that model now to other actors in the system and say, this is what we have accomplished with the Chinese, you can match this or do better than it. I think this is, and the ability to, China's demand for a greater role within the international system also helps here, that China can be the first among many to say, I am the first who is able to find a system to be able to onward lend SDR. If you claim to want development, you should follow my lead to be able to do that. So I think here it is both to China's advantage and it is to the advantage of African countries to be able to work out. And maybe you don't want to use the grading system that Development Reimagined has done, but that is an option. you can come up with your own. So I think this is an excellent contribution to the knowledge and to the ideas and innovation around international financial system. It's a pleasure to be here and offer these comments.
Thank you very much. Let me now invite Ying Qian, formerly with Asian Development Bank and now with Boston University's Global Development Policy Center. Ying, please.
Thank you, Professor Wei, for inviting me, and I have a pleasure to read the paper by Hanan and Aitor. I think it's offer a very comprehensive analysis of all the issues involved, providing adequate coverage of the background of SDR allocation and the channeling process. And the 5 specific options are all very reasonable. I'm not going to repeat that, but rather than just highlighting the views or the criteria, the options and scores, I kind of feel that it's probably more coming from a perspective of African countries. I guess in the long run or in the next phase of research, probably we can interview more people like to add perspective from China, which probably more or less matching of African countries' perspectives, and also look at the technicality side from IMF. Although my previous commentator said a lot of IMF needs reform and so far so forth, but that process is probably going to come in the long run. In the short run, let's look at the practical solutions. So that's point number 1. And point number 2 is this $10 million equivalent SDR is not a small amount, even comparing to China's outstanding debt in Africa. So I would imagine China would follow a rather comprehensive long-term programming process, basically looking at how to allocate it rather than putting everything into one basket, right? And then some of the dimensions and criteria China probably going to look at is probably going to be similar to IC's discussion earlier, including, for example, what the development of objectives these SDR is going to be looking at, how to allocating to what kind of countries and what kind of sectors, and what kind of means of financing these SDR should be channeled. And also lastly, what impact is on the debt sustainability of receiving countries, because certainly the best match will be this SDR allocation will be helpful to alleviate some of the debt pressure the African countries are facing now. So by the end of the day, you're probably going to see a mixed portfolio of allocations, right? This is probably my point. The African Development Bank is a good choice, and certainly I do agree it does have the institutional capability of doing a lot of good work. In the paper, one option is we're looking at the equity contribution. That probably going to be a difficult one because in addition to willingness to certainly contributing from the equity investor, usually in these international organizations, you do have a very lengthy process of allocating shares, and it's probably a lot more political than financial. So the equity can be looked at, but we should also looking at some other solutions on the equity end. The hybrid capital instrument is a good choice, which I think is doable. But I here offer another consideration for African Development Bank to think is to issue subordinate debt as a tier 2 capital, which probably coming at a little bit more senior tranche compared to the HCI. And then certainly you do need a bit of more clear definition of tier 2 capital and whether SDR can be used for that purposes. And we do need a little bit more research on that. The sort of key point, probably number 3, is on the IMF facilities, which probably is doable with the PRGT and RST. The paper itself seems to be a bit negative on IMF conditionalities, which I fully understand. Through my previous work, we also encounter a lot of difficulties in that regard. But I was wondering whether it's possible for earmarking some of the China's SDR allocation through these 2 funds, through IMF, to certain countries. Earmarking, I mean, although it's channeled through the fund mechanism, but with the China participation, you will have specific targets and specific sectors, a specific policy set of settings. So that's one suggestion. The last point I want to offer is I also like the liquidity and sustainability facility. I think it's quite innovative, and it actually combines capital market of operations with the SDR allocation. But although you probably do have a little bit more homework to do, like also earlier elaborated, I do have one suggestion here. It's also suggested by some other researcher earlier in different form. Is on the China side. There was discussion on looking at the Brady bonds solutions to basically organizing African countries to issue Brady-like bonds in the new setting in these new years. And then the suggestion was to use proceeds, for example, from SDR allocation or channeling to African countries to buy Chinese government-issued SDR global bonds, and using those proceeds of bonds as collateral to the Brady bonds issued by African countries. Now, these routings probably make a lot of sense because the SDR actually never leave hands of China, rather than the global bonds became a collateral to provide credit enhancement to the Brady bonds African countries issuing. So out of that process, certainly the history was telling us that process in 1990s and was a successful one. And certainly maybe we can try on this round of the time and to see whether it's workable. And I do believe it's workable from an SDR allocation point of view, but certainly you do need to organize all the creditors and see how we come to the actual bond issue, which is certainly a little bit more challenging. So I'm going back to Professor Wang.
Thank you very much. Our session actually started 8 minutes later than scheduled, and we are 7 minutes past the scheduled time. So probably I look at our Q&A session. We don't have many questions. Maybe I ask one question to each, but you don't need to respond. Maybe you can respond in the Q&A slides. So I can have enough time for the. So you can respond by typing your answers, I guess, and I'll turn to our next session. So one question for the first paper is that for the first papers, in a way, very important in potentially addressing the following question. So when we think about official creditor versus private creditor game that Dr. Cheng and his co-author study, one of the questions I have is whether the official creditor of in many countries, financial institutions are politically powerful. So the observed pattern that official creditors offer bigger haircut relative to private sector haircut could be a sign of capture, that they are just using taxpayer money to indirectly subsidize politically powerful financial institutions. And the first paper potentially provide a test of it. So that's one possibility. So the more you see more haircut on the official side, the smaller the haircut on the private side. Alternatively, it's the one that the author seems to interpret, which is that the more official creditor offer credit haircut, the more private creditor have to follow. But I'm not sure the actual specification in the paper is set up in a way to formally contrast the two and test it. So I have some questions about that, but maybe the author can clarify on this. On the second paper, it's good to have people who think about the borrower country's interest and propose ideas. My superficial understanding is SDR allocation is not designed to be a money initially. It's part of the IMF member countries' reserve. In time of a crisis, that's the first tranche you go to with minimum conditionality or no conditionalities before you go on to higher orders. That means that it's not really a reliable form of aid. For countries that know they have no need ever to go to IMF for financing, potentially they have some extra SDR to share, which is kind of the example we talked about here. But we know, not long in the past, even relatively high income members of IMF, like Korea, like Greece, find the need to go to IMF for a program that makes sort of using SDR for their purpose to be a little bit tricky. So it's good, good that some countries are willing to share SDR, and we want to get, countries like US, Europe, together with China to do more of this. At the same time, I guess we have to keep in mind potential limitation of relying on this. I welcome the authors of the second paper to correct my misperception and perhaps share some thought on this. But you feel free to do this in the Zoom Q&A space. Let me turn to let me thank all the speakers and the discussants for your great presentation and sharing your insight with us. Let me turn to Ishac Diwan to chair the next session, please. Thank you very much.
Thank you very much. It's been really a fascinating discussion so far, and we're running out of time, but at the same time we're going to be building up on such a rich menu of ideas that I think we can kind of effectively go to the point. Perhaps just to sum up where we are right now, we have heard from Dr. Jin Zhongxia, who is the director of international development at the People's Republic from China, some very important position coming from China, which is strong support for multilateralism with IMF leadership, and really looking for a way to implement fair burden sharing. That's the big question. We heard from Dr. Gong Cheng that coordination pays. The pie gets larger when there is coordination. And we've heard from our colleagues from Development Reconsidered that there is a new element to add to the mix, which is SDRs, a misused, underused instrument that could really get China to innovate in this field. Now, to build on these ideas, we have 4 great speakers from China, from the IMF, and from the developing world. So let me introduce them quickly. We have Dr. Jianye Wang. Do I see you? Yes, who really has experienced the principles and the cultures of all these institutions. He's now the NYU Shanghai professor, but he was previously the chief economist of the China Exim Bank, and he was also a former IMF official, and with experience of restructuring of Eastern European countries. So you've seen it all, and you are going to help us, Doctor, find these win-win opportunities. We have Guillaume Chabert, who is the Deputy Director of Strategy, Policy, and the Review Department at the IMF, very closely involved with all these issues. Guillaume, great to have you with us. We have Hanan Morsy, who joined us from Addis Ababa. She is the Deputy Executive Secretary and the Chief Economist of the UNECA, the Economic Commission for Africa. She's been involved in debt issues, and you've recently held a meeting of the Minister of Finance of Africa. It would be great to hear from you, from what voices came out, what are their ideas about the way forward. And we have Simon Cueva, who is a professor now at the University of Ecuador, but was the Minister of Finance of Ecuador during, and he led the negotiations. And so he has experience negotiating with the private creditors, the Chinese officials, and the multilaterals. And he will also give us his ideas about win-win possibilities. Let me put on the table the few Chinese concerns that came out so far. It'd be great to hear ideas about win-wins and progress, and how improved mutual understanding can allow us to move forward. The first was the MDB debts. Should that be treated? How to ensure fair burden sharing with MDB debt? The second is the perimeter of debt restructuring. What to do with the SOEs, with debt to assets that are producing, domestic debt held by non-residents. Third, and this is something Diego Rivetti raised, which I thought was very important, how to apply actually the comparability of treatment. And finally, to add to the mix, how to use the SDRs best to innovate and move productively. So without further ado, let us hear from our panel, perhaps 3-4 minutes each, and then we'll come to a second shorter reply so that we have interaction among yourselves. So Dr. Jianye, can we start with you?
Well, I already told Martin, I want the other three speak first. Okay.
Okay. Would you suggest speak first? Well, let's start with Guillaume. You'd like to speak last, if I understand correctly?
No, I got the email from Martin Kessler. Okay. So he already told me the sequencing of speak and who is speaking what. I don't know. He shared the email with you, Ishac.
We're not that coordinated.
Okay.
Sorry, Ishac. So in Martin's email, sorry, Ishac, in Martin's email, he suggested the Hanan to speak first, if I remember correctly, followed by, I forget, either Simon or Guillaume. So Simon next, Guillaume the third, and Jianye the last.
Well, I'll go with that then. Hanan, please get us started.
Sure. Good afternoon, everyone. Great to be with you. We've just actually finished our Conference of Ministers, African Ministers of Finance, Planning, and Economic Development. And the issues that we've, discussing here have been, some of the key issues that were discussed. And during these meetings, we actually held a meeting of the African high-level working group on global financial architecture, which includes the ministers as well as key stakeholders, IMF, World Bank, African Development Bank, African Union, and Afrexim Bank, and Economic Commission for Africa serves as a secretariat for that group. So actually the discussion of that meeting focused on debt issues and what need to be done in that area. And among the key things that were voiced by African ministers is the need to overhaul the G20 common framework to make it more time-bound, effective, and transparent, and to expand eligibility to include middle-income countries, and also to expand the creditor committees to incorporate private sector creditors in order to smooth coordination challenges and accelerate restructuring, to also establish a comparability of treatment formula to reduce technical disputes and accelerate process, and to have, to suspend debt service upon application to the common framework in order to provide some relief and give incentive to speedy restructuring. We also discussed the need for bolder use of IMF lending into arrears policies to reduce leverage of holdout creditors. And among the number of other things that were discussed was the issue of the need to reform the legal and regulatory framework for debt to basically strengthen that framework by requiring international jurisdictions for debt issuance, to require enhanced collective action clauses and force majeure clauses, and to implement anti-vulture fund legislations. So these were among the, the key issues that were discussed, but also during that meeting, there was also a presentation on a Sustainable Debt Coalition, which is an initiative that came out of COP27, put forward by Egypt to basically have a coalition to propose new approaches to managing existing debt, reduce cost of new green borrowing, promote efficient use of financial resources in alignment with SDGs and Agenda 2063, and also to promote the debt for climate investment swaps, and that to kind of help countries also come up with well-defined key performance indicators for green financing and standardize and strengthen the reliability of these key performance indicators. So these were among the things that were done, and actually there are a number. It was supported by over 23 African countries, the coalition that expressed interest. It's intended to really bring African countries, and actually, by time this will be expanded to include countries beyond Africa, to really help in, unleashing a more particularly green finance and help in improving the design and availability of it. So these were among, the issues that were discussed. I think perhaps maybe let me also comment on one of the things that you've raised, Ishac, which is the issue of the multilateral development bank debt and how to be treated. I think the key thing here is that this is beyond the individual countries, because these are institutional issues, and what is important is to avoid holding back on progressing and restructuring because of these issues that goes beyond what countries themselves can do. So I think that would be really the key point I want to just leave with us, because currently among the majority of the countries that are in debt distress are African countries. So we need to make sure that these issues are not being an impediment to really progress in an orderly and timely manner for restructuring. Back to you.
Thank you. Thank you so much, Hanan. These are extremely valuable recommendations coming from, the African continent. Simon, to turn to you, perhaps you have reactions on whether you think this can form an agenda for the South, and what is the views from Latin America and from other regions,
Yes, Isaac, thank you for the opportunity to be here. Thanks to everybody in this very nice panel. Very briefly on Ecuador, as maybe not all the participants are familiar with Ecuador history, is that Ecuador came to, before the COVID crisis, with an already very weak fiscal position, international reserve position, which obviously deteriorated with the COVID, and had very limited financial alternatives, with large fiscal needs and no possible use of monetary policy, as Ecuador is a dollarized country. So at that time, what Ecuador engaged was in an effort in three parallel dimensions. One, to discuss a large IMF support through, at that time, an extended fund facility with exceptional access and quite a large front-loaded component. The other part would be to engage in the sovereign debt restructuring process with private creditors, Eurobonds, which ended with a significant debt relief and maturity extension system. And thirdly, while the fund program was pursued as successfully concluded, Ecuador also engaged in discussions with the Chinese authorities so as to conclude in a reprofiling of China's debt, which provided important debt service relief for a few years. So in that sense, it's true that Ecuador has been one of the few countries probably managing to negotiate in parallel debt restructuring with Eurobond holders and with the Chinese development banks. However, there are maybe a few differences that make Ecuador a bit different from several African or Asian countries that currently face similar issues. The one is China was not the main creditor of Ecuador. China's debt was probably 1/3 of the private sector debt. And that's, while China was a relevant actor, you could continue with fund discussions and with the debt restructuring program and DSA considerations with sovereign bonds before engaging in a more detailed discussions with China. Other countries may not have that luxury, and that brings to other issues there. The other one was that in the case of Ecuador, the actual debt relief component from China was relatively smaller than what it was from sovereign, from private creditors. And the issue for Ecuador with China was more in terms of debt service relief than in terms of stock relief in the case of China. As China, debt was probably of shorter term and higher rates compared to the other ones. The third one is from Ecuador experience and negotiation is that it was pretty important to get parallel and hand-in-hand discussions both on the technical front with Chinese banks and on the political front with the Chinese government. Those were really very closely hand-in-hand, and without that, it wouldn't have worked as it worked. Maybe coming back, Isaac, to some of your points on and how I see that may working. I will push for a few things. The one is transparency efforts, and you hear more and more this in several parts. You hear several countries asking for a sort of, and creditors asking for an early publication of the fund DSA parameters and calculations, because that could help everybody to understand how a country's debt is reduced from the initial point, and what are the efforts of each side and how much is due for the rest. So that could be a very positive, and I guess Guillaume may talk about that. The other one is this issue of an early publication of the fund-supported agreements, as in many countries, and Ecuador wasn't the exception, building more local understanding and buy-in for policy that can be politically difficult, could help. And maybe part of the internal funds system may delay a bit the possibility of publishing that part. The other is more on the technical work part, as probably you mentioned and some of the questions mentioned, this issue of comparability of treatment, how to ensure the related calculations, how to calculate the equivalent NPV reduction, how to include debt service versus debt stock considerations. I say those ones are relevant. In the case of China, also how to treat directly or indirectly collateralized debt as part of the China's debts are to some extent collateralized. And maybe the other part would be this issue of how to ensure that the MDBs has enter more in this debt burden sharing component beyond the simple positive net transfer policy that typically has been applied to developing countries. And there you could imagine either a sort of HIPIC style fund could help in that regard, or the other way would be, someone mentioned also, how to use in an innovative way the SDRs money, and maybe part of the SDRs flows could help in that regard. So to give a breathing room to countries during the negotiation and during the implementation of policies that could help the countries get back in order and get back to more stronger fiscal situations, so as to move in that regard. So I hope this was clear and short enough, and let me give back the floor. Thank you.
Thank you, Simon. Indeed, the issues, I think, are very clear on the table. Voices, from Africa, from Latin America, and from China are very clear. So, Guillaume, to you, I mean, what is striking is that everybody expresses the need for the IMF to take the leadership in resolving these issues. What are the views of the IMF leadership on the way forward, on how to make progress given the various positions on the table?
Well, thank you very much, Isaac, and thank you to the Finance for Development Lab for inviting me. A lot of good things, excellent things, in fact, have been said since the start of this conference, so I try to bring my contribution, which may be difficult, but I like very much the way you framed this panel discussion, which is, are there, ideas that would bring a win-win solution? Can we make progress? Can we improve the understanding of the different stakeholders? Recognizing two elements which I think we all share. One, which is the worrying debt situation. The other being the reality of strong, huge geopolitical divide. So there are things we can do in that context. There are others that maybe
out of reach in this given context, not to say that they are out of reach in principle, but we have to take, of course, into account the realities of the political divide and the fragmentation which is there. So having said that, perhaps a few considerations, starting with what is our assessment of the debt situation. I mentioned that we are worried, as everyone, I think, around this table on the debt situation. We will publish in a few days' time an analytical piece, a working paper that took us more than 1 year analytical work to compare the debt situation in low-income countries now versus what was the situation before HIPC. And yes, our finding is that we are relatively far from what was the situation before HIPC still, but the trend is not good. And we may come to a situation where indeed the debt ratios are similar to what was there were pre-HIPC if nothing is being done. The main conclusion of this working paper is that we still have the time to act before we are in a HIPC situation. And that includes, of course, whatever can be done in terms of, growth enhancing reforms, domestic resources mobilization of the private savings in countries, and the international support, scaling up the volumes and type of support that the international financial institutions and the bilateral donors can bring to low-income countries. And also, very significantly, improving the debt restructuring mechanism where a debt restructuring is already needed or would be needed in the coming few years. The common framework is definitely not a tool that could be applied if we were in a systemic debt crisis. The common framework is the antithesis of HIPC, if you so wish. Common framework is a case-by-case approach. It's not something which can be, let's say, industrialized as was HIPC. HIPC, you had a list of eligible countries and it could go fast because you had, systematized approach. Agreeing on HIPC took years. If you remember the history of those countries, I think one of these slideshow earlier presented the fact that the Paris Club started to provide relief in terms of present value of debt starting 1988. And it's only in 1996, almost 10 years after that HIPC came. So it took years before the then main bilateral creditors could agree on a HIPC solution. And if you think of the MDRI, it was 2005. So basically almost 20 years from the recognition of something was wrong at the end of the 1980s and the full implementation of HIPC plus MDRI. If we can avoid, such a protracted process this time around and provide solution to debtor countries that work efficiently without wasting a decade, that I think would be absolutely critical. So I like very much the idea that we can find indeed a win-win approach, including on accelerating debt restructuring, recognizing that the context is much more complex than it was in the 1990s in terms of international cooperation and willingness to cooperate. So coming to your targeted questions, Ishac, I think on MDB debt, this is definitely an issue where we would welcome some, or quite a lot of better understanding on what is it that the IFIs should do to support a country facing a debt restructuring. Our view at the IMF is that the development needs, the climate finance needs are so huge that it's not only an issue of debt restructuring, it's also an issue of funding, of providing new money for the future. So moving, the international debt discussion from the divide and opposition that we have seen over the past 3 years on how best MDBs and other IFIs can support countries and they're taking it debt restructuring to a recognition that what is needed is grants, new money on concessional term, and that's where we should be headed. There are a lot of discussion at the World Bank, at the June summit that the French are organizing, at the UN with the AGC summit. Let's take this window of opportunity to indeed scale up the support to countries undertaking debt restructuring and developing countries all together in terms of volumes of financing and type of financing. That would be a major breakthrough, we think. Now, there is also an issue in terms of better understanding, as you mentioned, on a series of key concepts, definition approaches where definitely the consensus that existed 25 years ago among the key stakeholders doesn't exist anymore, and it has to be rebuilt. So you know that the IMF, the World Bank, and India, as the G20 presidency, launched a few weeks ago this new global sovereign debt roundtable. This is really about indeed having greater common understanding on key concepts, key approaches. I think that at this stage, there is not even a common understanding on what is a cutoff date for a country undertaking a debt restructuring. Sri Lanka came into default in April 2022. At this stage, there is still no recognition among the key creditors about what is the cutoff date after which new money provided to Sri Lanka would be excluded from the debt restructuring. This is a complete disincentive to provide new money to a country into crisis. So even a simple thing like defining a cutoff date or having a process to define a cutoff date is not common knowledge at this point in time. So there are many, many things that could be improved. Pragmatically, would be a win-win for everyone, because improving the processes would be in the interest of the debt-led country and its population in the first place, for sure, but also for the creators. So to make a long story short, we are willing to push in the coming weeks, a reasonable compromise where indeed the IMF and World Bank could do better effort in information sharing early in the processes, providing data on the macroeconomic frameworks, the parameters for the debt sustainability analysis, etc., to help accelerate the process. Finding a way to anchor the international community around what is the role and how best could IFI support countries undertaking a debt restructuring should be really something we should find an agreement soon enough. And clarifying the key concepts, comparability treatment, cutoff dates, timeline, as Hanan, I think, mentioned, would be absolutely critical. And that can be done, and we shouldn't wait for months for that to happen. Let me stop here.
Thank you very much, Guillaume. So, Dr. Jian, you've heard all of this. There seemed to be a lot of convergence. What is your assessment?
Okay, I like the comparison by the gentleman from PDR, IMF, compared two countries' debt now to the 1990s. And let me tell you that during that period, in the 1990s, for African countries, Paris Club developed the country, OECD creditors share and sovereign debt of African countries, which is much larger than all other combined. So you do the classic term, Toronto term, London term, Naples term, and one by one go to HIPIC, 1996, enhanced 1999. So we have to look at the comparability of treatment and burden sharing in context. As long as Paris Club did it, and the remaining they have to follow. At that time, there's a commercial bank lending, right? The London Club. Now, what is the situation now? I have asked my people to calculate for low-income countries and lower middle-income countries, i.e. in 2001, per capita GNA below 4,000, I don't know, 100 US dollar. For this group of countries, you know what is the share of the multilateral? 1/3. You know what is the share of bonds? We're very diversified, right? So it's not organized and the famous collective action problem for them, 1/3, and plus other commercial. So these all together, 3/4. Official bilateral, only 1/4. Don't forget, after 1990s and the debt reduction under the HIPIC, Paris Club or of OECD country no longer lend. Because you talk about the long-term trends, we all care about the financial flows to the poor countries. Every time when you do this thing, there's a long-term consequences. You have to think about it. Okay, so I think you have to look at burden sharing in perspective. Nowadays, there's a genuine concern for free ride by bond riders, by bondholders. And multilateral, a big share, right? And they do the calculation. They don't provide debt relief, and they talk about the comparability and burden sharing. And there's a real chance the burden of a deep cut, clear cut, to lower the PV, prevent value of the debtors, sovereign debt, government guaranteed, to quote unquote sustainable level, would fall on a few official bilateral creditors. They're only 1/4, of which only 8% China. Now, I keep this thing, I'm not complaining. I think I have been working in the fund for a long time, and you go back in the early, those days, there's a many paper, ball paper, and you find my name on it, right? I've written it. So I know all this, but I want to give you this thing in perspective, because we like to talk about the burden sharing, talk about comparability of treatment. Now, then come back to what I want to really tell you now. It's I know G24 intergovernmental group, right? On international monetary affairs and development, now chaired by Yapu Masha, formerly at the IMF, and she was in my team, right? In my mission, so now she is the head of G24. Now they calling for fair, meaningful, and timely sovereign debt resolution in 2020. We hear it. We all aim for it. Now, has progress been made under the DSSI and later on at the common framework? You mentioned Chad, Zambia, and a few days ago, outside the common framework, Sri Lanka got it's an EFF, right, 48 months, $3 billion. So I think a progress has been made, but it's different from the old days. So that's what you mentioned. In 1990, it's the Paris Club. Now then comes the question, because the composition of creditors have changed a lot, right? It's on two accounts. One is bondholders increase hugely their share, and within the official bilateral creditors, and the Paris Club becomes small, and non-Paris Club, China, in many cases become the largest official bilateral creditors. Now, to do things under the common framework, China will have to be proactive, right? Play a leading role. But then the question is what difference between China and the Paris Club creditors? Can you tell me? I think you have to think about it. The procedure is the debtor go to the IMF, ask for new money, ask for program, and the IMF need the financing assurances, right, to close the financing gap despite the recent review and the change of the lending into arrears, right? So then the creditors have to work together and give financing assurances to the fund, and then they calculate the fund team mission and calculate and what is the debt relief needed. Then the Paris Club, cut off day, then do a wholesale debt relief according to the calculation. Now, that is the Paris Club. And when you do those things, there's a clear, right, identification or separation of what is official claims vis-a-vis non-official claims. Because you were wondering, how could China, just not too long ago, 2 decades ago, was a low-income country, how could it all of a sudden lend so much? If you look at their budget, you compare to OECD, how much their budget allocation for international development? So then what must be true? Very little, right? Their budget has very little allocation to international development. They compare to the OECD. OECD, you have a 0.3% of GNI, whatever, right? For ODA. So your ODA by institution, by budgetary allocation are very clear. So because of debt relief treatment, ultimately is who bear the cost of the treatment of official debt right? So for debtor side, it's government guaranteed. For the creditor side, has to be official claims. The official claim eventually is the taxpayer to bear the burden, the cost. Now, then I come back to the question, so how can China lend so much? What must be true? Very large part of Chinese lending to those countries actually is commercial-based project financing. They are win-win. How can you have win-win? In OECD, they give them, right? You know, the ODA, over 85% are grant element. They don't lend anymore. Now what we do is they channel through the multilateral institution. But for the win-win from the country like China, and they've gone through the transition, right, from planning economy to the more market-driven system. So in the process, it's a lot of lending going out. So there's this very large part commercial based. And the gentleman from, I don't know, from the World Bank, in the comment, there's a chart on the interest, right? You see that the multilateral is very low, and there's some certain very high interest. And they're well documented by various think tank. They collect the secondhand data and combine and find the Chinese lending. Many, especially you know, CDB and even China Exim, right? They are at the high at price on the market price. So that's the to do a treatment of debt, right, for China. And then the question is can and should Chinese taxpayers shoulder the cost of more and more international debt haircut, right, or do a payout? So that's a genuine concern, because so for them it's my view, they may not think that way, but I think it to some extent, as previous speaker hinted, I think that they have to sort out and clearly separate their official and non-official claims. Because in the end, is who bear the cost. Because MDB ultimately is a taxpayer too, right? So official is by definition. So in addition to who bear the cost, right? Because it's non-official despite the state-owned and their shareholders, their managers, right? So there's accountability, there's a moral hazard. So you look at domestically, there's a large local financial platform and borrowing. And now, you know, in China, the central government, they don't bail them out. So use the Chinese words, it's a whose kids who have to take home. So they have to face the consequences, right? So they have to be accountable. If their shareholder are wiped out, and they have to wipe out. If the institution are gone, they have to go. They have to go. So aside from this, a moral hazard, right, and fairness to the Chinese taxpayers, and I think there's also issue of domestic financial stability, because many of these institutions that issue debt, the main funding comes from the debt market. So large write-off, so it do have a consequence. So I think I mentioned this thing to you, and then you appreciate, right? So you know what happened in the past. Private sector corporations from developed countries, they seldom go to the very poor countries because very high risk. They know it. And the Chinese company going there, And they know sovereign guarantee by those governments do not mean much. Hence, the common practice of collaterals, asset and project revenue collateral are there. So there's a common commercial practice. But of course, now there's an issue because affecting the multilaterals, right? They prefer credit and so on. And when it comes to debt structuring, it become complicated. But I say this thing is a domestically there's a genuine concern, and when the Silicon Valley Bank, right, things happened, there's no bailout from the U.S. Treasury, and here too, in China too. So they I hope you appreciate, right? So these I don't know I have enough time to talk about this thing, but I think that
these are
on the whole that the authorities support the common framework, and they support developing countries. They want to, do well, fair, meaningful, and timely debt relief, right? But they need to do their reform at the home, to relax domestic constraint. And by the way, this clear separation of official and non-official claims is also in the interest of the developing country, the poor countries, over the longer term. Because because after this run, I don't know how many official money will continue to flow. Because you look at the longer term financial flow to poor countries.
Thank you, Dr.
IMF flow will gradually replacing official flow, and within official and multilateral replacing bilateral. So continue the commercial engagement, commercial flow is important. I think that I just end here, right? So we can have some discussion.
Thank you very much for this reality check. I mean, clearly, China is a developing countries, and the government, the authorities have to deal with the taxpayers, with financial stability, and these are, very important concerns and complexities in the current situation. We're running a bit out of time, but we have enough time to go back to each panelist for 2 minutes reaction to what you heard, maybe views on win-wins and the way forwards. And from the Q&A, I take several questions on an issue that Guillaume raised, which is the importance of new money, of new lending. The fact that we're not yet in a tsunami of debt, but we risk going there if there isn't enough support for developing countries, for African countries to deal with the current shocks, the very negative series of shocks that they are experiencing. And so the importance of new money to avoid getting into a bad situation. Several questions on that. So let me go around, starting with Hanan, who has to leave us soon. Hanan, were there concerns of this sort at your meeting with the ministers of finance?
Yes, indeed. One of the key concern was the issue regarding terms of lending, given the change in the global financial environment. Basically, what was raised is the need to have lending that is more affordable at more concessional terms and longer tenor to enable, recovery and development needs, SDG investments and all that. And here there are, I think it's one of the areas where IFIs and MDBs have a role to play to really, both through taking more risk on their balance sheets, as well as through availing instruments that can allow such, lending at better rates. And also, one of the things that also was discussed is the potential for rechanneling of SDRs through multilateral development banks to enhance, the leverage to 3 to 4 times of the same resources, and enable to have these type of lending available. So that was also among the issues that were raised, and we had extensive discussions regarding the need to actually enhance the rechanneling system to give more incentives for it to actually happen. So all these, and also the use of things like official support and guarantees, de-risking instruments to enable countries to actually, tap international markets at more, affordable rates. Things like what was done during, with the Brautigam bonds. So all these type of issues have been raised and discussed, and there is a sense that, there is a need for change. The current paradigm is not working, and we need to have solutions to fix that, to make the global system more just and equitable, particularly for developing countries and African countries.
Thank you so much, Simon.
Yes, hello. Very, very interesting discussion and comments. I would just point to 3 new issues. The one is, as you mentioned, Ishac, in the current context, many developing countries are starting to find much more difficult access to markets at reasonable rates. And so you'll get, as everyone sees, more and more competition for scarce flows, basically. And so the more we can get faster in terms of leveraging more options, maybe, the World Bank recently announced some more flexible policies for lending and use of capital. Some also issues that you hear more and more competition for lending objectives between development needs, climate-related issues, use of guarantees for market access, and so on. And still very little appetite for some sort of recapitalizing or changing the rules in some of the AFIs. And so that may become a more general issue. And as Guillaume was saying, the common framework was designed for a country-by-country approach. And we may be going more into a general concern of market access that may end up being an issue there. And lastly, on some of the comment by Professor Wang, I thought were very interesting in terms of these issues of how to divide commercial versus official lending and how to ensure long-term availability of developed countries to funds. But it's also true on the other side that negotiating with China is not always easy in the sense of understanding exactly who decides what and which is the common window where you can go and discuss it. And so you need a lot of back and forth between different parties and political and technical parties and so on. And so I think part of this issue, same as Guillaume who was mentioning for the IFIs to be clear and put information earlier, I think also in China's part, how to ensure a sort of clear approach to the discussion so that developing countries know better who to address when could be very useful. I'll stop here.
Thank you, Simon. Professor Wang, can I take the liberty to come to you so that I ask Chabert, Guillaume, Chabert to conclude? Just from what you've heard, maybe from a more constructive perspective, how do you see the way forward?
Okay, I think that Simon has mentioned this. Sometimes find it a bit difficult in dialogue with the Chinese part. I don't know which institution you're talking about. I think that is situation is a bit chaotic because we have so many different institutions are doing their lending, and so within China, they have to push forward the structural and institutional reform. to finish the transition to. I know the Sri Lanka paper, that the EFF paper, I clearly put the CDB in the private sector commercial bank. Thank you. IMF eventually get it, okay? And I hope the IMF, the World Bank in their IDS next year and change it, right? And I think the last 2 years, they still put the CDB is a so-called policy bank. So Simon's question is China need to do more in terms of domestic coordination, horizontal, across agency, across lenders, and as well as vertical. And also they have to improve their communication and consultation with the IMF and the World Bank to find the pragmatic solutions under the common framework. So that come back to your question and how to move forward. I think that this because I hate to say this thing is the PBC, the central bank, send a representative to the fund, right, as executive director, and the Ministry of Finance and send people to the World Bank. But these two ministries, the central bank and the Ministry of Finance, they don't that directly oversees the lending institutions. The lending institution is on its own, have its own governance. And and here is not just a coordination though. They have to sort out, align the accountability, interest, and hardening the budget constraints. So this is a huge moral hazard. If we don't do this going forward, and even you externally you deliver the debt relief to country A and B and C, but you leave mess in China. So they have to do it in hand in hand. It's not only dealing with external is a small part. Domestic, that's a huge debt problem they need to handle, right? So they are facing huge. It is. So I think that okay, I'm almost there. I think that for the fund, I would suggest we have to be fully aware, right? The multilateral is a very large share. You do the calculation for debt relief, but you are not delivering, right? You're not participate. So you were talking about the. We know it's not because it's not to the hectic moment. It's because you don't have the voting shares of support at this moment, right? In the board, but I think I'm mindful of that. When you do the calculation, you put your and multilateral debt there and to calculate the share of the bilateral, and you put the bilateral the private the bondholder there too, right? And you hold them to the comparativity treatment. Then for fund and MDB, use grant instead of more lending and short term. Right, you use very long term, very low interest, or even grant to deliver your share of the debt relief.
Okay, thank you very much. We're only running 4 minutes late, which is very good. So Guillaume, you have a few minutes to conclude. You know, what have you heard? What you make of this as you go to the next roundtable, which is in a few weeks.
Thank you, Isaac. And I'm a bit embarrassed to be perceived as concluding anything. I mean, I'm participating in a panel discussion. And again, it's super useful to have the different viewpoints. I would like to start, in fact, by acknowledging that indeed there are progress. I think Professor Wang, in his first intervention, mentioned the fact that there has been progress with Chad being the first case of, the common framework implementation, having gone through the entire process. Zambia has moved. It's complicated, but it has moved. Ghana is now requesting a common framework treatment. Sri Lanka, outside of the common framework, there was a major breakthrough earlier this month, and we could indeed bring the program to the board. So there are progress. It's not as if everything was not kind of moving in the right direction. The key issue, though, is it's moving slowly. And the reality of the debt concerns is that it's moving quicker than the progress we see. So we have to find a way to accelerate the approach on how to deal with the debt concerns. Again, in the interest of the debtor country in the first place and their population, countries having a debt restructuring, they cannot wait for 6 months to have the international community coming to their support. First, because it's precipitating and aggravating the crisis. Second, because the window of opportunity to undertake reforms that are inevitably very unpopular. If you don't have financial support, the window of opportunity to undertake reforms is closing very rapidly. And it's precipitating, again, crisis, which is not in the interest of the debtor and the population in the first place, but it's not in the interest of the creditor also, because ultimately the recovery value will be lower. In the terms of the progress made, I think on our side, it's now about clear that China Development Bank, CDB, we take the view of the country. China has told us through the DSSI that China Development Bank is a commercial entity for the application of the IMF policies, and I think we respect that. We don't challenge that. So we're not responsible on our side on the statistics that are published on the World Bank's website, but just to mention that I think this is also a progress. I think before the DSSI, it wasn't so clear what was the status of the scheme, or at least there was a misunderstanding between the different stakeholders. So again, there are progresses, but we need to accelerate these progresses. And indeed, the Global Sovereign Debt Roundtable is meant to provide for the first time ever, a kind of format where the new creditors such as China, India, Saudi Arabia, the traditional private creditors, but also the private creditors and the borrowers can directly, exchange views on what is the shortcomings, what are the shortcomings, and how can we overcome them. And I will just finish, Isaac, by what you started with, in fact. I think for the next few weeks, it would be extremely desirable to find a consensus on what is the role of the IFI. Should they provide debt relief with the risk that indeed they would be hurt in terms of providing the scale of volumes of new financing in the future? Or should we work together on ways to ensure that indeed there is more grants and more concessional financing for the countries undertaking a debt restructuring? That's really for the membership to decide. There are pros and cons on the two aspects. We, on our side, are more on the view that what is needed is the provision of volumes and type of new financing that indeed will provide new funding for the years to come for these countries. But we hear that there are also views, and this has to be discussed. That's a key issue to be solved rapidly. As Hanan said at some point, I think this issue should not hold the ongoing debt restructuring cases out. We should move on Zambia, we should move on Ghana, we should move on Sri Lanka, and have separately a discussion on the architecture, because otherwise those countries will just be stalled and stuck. And yes, a clarification on the perimeter of debt, on how to apply comparative treatment, all that is absolutely critical to facilitate the processes, and definitely the use of SDRs to channel these SDRs that are not used in some of the balance sheets of the more robust countries, to channel that one way or the other through either the IMF instruments, PRGT was mentioned, RST was mentioned, but we are also supportive of whatever can be done to channel SDRs through MDBs if that works, would also go a long way. And just to finish, because it's a conference which is very much related to China, we are extremely, extremely grateful to the decision made by the President of China to allocate indeed a huge share of the SDRs, either through multilateral channel or bilaterally. And we are definitely willing to continue this work together. Let me stop here.
Thank you, Guillaume. This is a very positive and constructive way of stopping, but also of continuing this. To conclude, I remind this was part 1 of our conference, and that part 2 will be on Wednesday. So I want to really thank our panelists and the hundreds of participants that were listening for 2.5 hours. Really exchanging ideas, listening to each other can only promote a better mutual understanding, which is really the goal of these discussions. Today, we very much focused on short-term difficulties. In part 2, which should be on Wednesday, we want to focus on the longer-term issues. The real challenge is development. China is a key player in supporting development in poorer countries, and we want to explore in the next session how support for infrastructure, how support for green finance to save the planet, those joint interests that unite the world are fostered but by what China does. So again, thank you very much for joining us and hope to see you on Wednesday. Bye-bye, everyone.